If you own stocks, or even if you just have money sitting in a 401k, what is happening right now between the Middle East and a small island off the coast of Florida could either make you significantly wealthier over the next decade or quietly destroy a very large piece of your purchasing power. Most people think this story is about oil. I do not think that is the real story. Oil is the headline. The real story is the slow unwinding of a 50-year monetary arrangement that has made the dollar much stronger than it otherwise would have been, allowed the United States to borrow more than almost any country in history could borrow, and supported the valuation structure beneath your stocks, your bonds, your retirement accounts, and your savings. That arrangement is the petrodollar system, and if it is truly weakening, then we are not talking about one geopolitical event. We are talking about a long wealth transfer. The people who understand the sequence early will position themselves for it. The people who keep staring only at the headlines will feel the effects long before they understand the cause. So let me give you the framework the way I see it. First, the petrodollar weakens. Second, money rotates through what I would call the great reshoring. Third, the resource rush begins in earnest. If you understand those three phases, you do not need to predict every weekly headline perfectly. You only need to understand where capital is likely to go next and which assets become fragile when the old system stops supporting them the way it used to. Let us begin with the petrodollar itself, because without that piece, none of the rest makes sense. Back in 1974, Saudi Arabia agreed to sell oil in US dollars. That mattered far more than most people realize, because once the world as most important energy commodity was systematically priced in dollars, every country that needed oil also needed dollars. And if you need dollars in size, you usually do not just hold stacks of paper notes in a vault, you hold dollar assets. Most importantly, you hold US government debt. That created something extraordinary, massive built-in demand for dollars, massive built-in demand for treasury bonds. And that meant the United States could run deficits and issue debt into a global system already conditioned to absorb it. That is one of the great hidden privileges of the last half-century. The world did not just tolerate American debt. It needed the monetary plumbing underneath American debt. That is why this matters to your portfolio, because a large part of the financial world you know has been built on the back of that demand. So when people say the petrodollar is dying, they do not mean the dollar disappears tomorrow morning or that nobody uses it next month. That is not how reserve transitions work. They mean the special support structure underneath the dollars is weakening. And if that support weakens, countries need fewer dollars than before. If they need fewer dollars than before, they can own fewer treasuries than before. And if treasury demand weakens, bond prices come under pressure. When bond prices fall, yields rise. When yields rise, the discount rate used for all kinds of financial assets rises too. That is how currency shifts become stock market events. That is how something that sounds abstract and geopolitical turns into something very personal inside a retirement account. People say, "Why do I care about a 1974 oil arrangement?" You care because it has supported the price of your financial assets for decades. Now, why is it weakening? Not because one treaty expired in a dramatic ceremony, because alternatives are slowly growing. The BRICS countries are settling some trade in local currencies. The Middle East is increasingly comfortable forcing the world to think about alternative trade routes and alternative settlement arrangements. The dollar is not vanishing overnight, but its monopoly, like privilege, is weakening at the margin. And in systems this large, the margin is where the future begins. This is why one of my old Wall Street mentors used to tell me something I never forgot. Currency shifts create some of the biggest wealth transfers in history, not because everybody notices them immediately, because almost nobody notices them immediately. Most people notice after the move has already worked through bonds, rates, equities, and real assets. That is how the transfer happens, quietly. Now, let me move to what the United States appears to be doing in response, because this is where the story becomes far more interesting than people think. The American response is not simply to complain that the old global order is changing. It is to adapt by pulling the productive base closer to home. The phrase people use for this is friendshoring. There are various flavors of it, but the broad idea is simple. If far-flung global supply chains are becoming more fragile, more political, and more expensive to protect, then the United States has every incentive to bring energy, production, logistics, minerals, refining, and strategic manufacturing closer to its own sphere of influence. That is the real shift from global policeman to regional gatekeeper, from relying on distant supply chains to building a more consolidated hemispheric one. And once you start looking through that lens, a lot of current events begin to look less random. Take Venezuela, strip away all the moral theater for a moment, and look at the hard economic reality. Venezuela holds enormous oil resources, and the quality of that oil matters because it fits the U.S. Gulf refining system unusually well. So if Venezuela becomes more accessible or more integrated into a U.S.-friendly supply architecture, that is not just an energy story, that is part of a regional security and industrial story. The United States has effectively become one of the dominant oil exporters in the world already. That changes how America thinks. A country that is an energy consumer under constraint behaves differently from a country that is increasingly a processor, exporter, and controller of regional energy flows. That leads naturally to the next place people are not paying enough attention to. Cuba. Most investors hear Cuba and think cigars, old cars, failed ideology, tourism, and stagnation. They do not think strategic minerals. I think that is a mistake, because Cuba appears to hold significant deposits of exactly the kinds of resources the next half-century of technology, defense, electrification, batteries, and industrial modernization will require: cobalt, nickel, rare earth, related strategic materials, copper exposure through the broader mineral system, precious metals too. This is the sort of mineral profile that becomes far more important when the world is moving toward batteries, drones, electric systems, data center build-outs, military electronics, and broader electrification. People are watching the Middle East because they think the big story is oil. Smart capital is also watching the Caribbean because the bigger story may be resources. That is what I mean when I say this. It's not only about the old energy system dying, it is also about the next industrial base being assembled. Now, I am not telling you that Cuba opens up tomorrow and instantly becomes some smooth capitalist success story. That would be childish. What I am saying is that if the U.S. strategic system is moving toward regionalized energy, regionalized supply chains, and tighter control over the critical minerals necessary for the next wave of defense and technology, then a place like Cuba stops being merely a political curiosity and starts becoming an asset map. And when an asset map changes, capital follows. Think about what would be required if Cuba became more economically integrated into a Western or U.S.-led system. Over time, ports, mining operations, power systems, refining, roads, rail, storage, shipping, communications, service companies, construction, logistics, equipment. The wealth transfer is not just in the minerals themselves, it is in everything that has to be built around them. That is Phase 2 and Phase 3 of the framework. Phase 1 is the weakening of the old dollar support system. Phase 2 is the great reshoring and regional rebuilding. Phase 3 is the resource rush into the assets that make that rebuilding possible. Now, let us talk about how money actually moves through something like this, because that is what matters for your portfolio. When the dollar as special support begins weakening, two things tend to happen. First, long duration paper claims become more dangerous than people think. Second, real assets become more valuable than people think. This is not because every asset behaves the same way. It is because a weakening currency regime changes what the market rewards. If global demand for treasuries is less automatic, then long-term bonds become much more vulnerable. A lot of people do not realize how much of their retirement money is tied up in structures that depend on the idea that U.S. government debt is always the safe, sensible default place to sit. If that assumption weakens, long-term bonds can get punished badly. The mechanism is not mysterious. If fewer foreign buyers need dollars and therefore need fewer treasuries, treasury prices can weaken and yields can rise. If yields rise, the value of long-duration bonds falls, and once yields rise, a great many safe portfolios stop feeling safe. That is why I think one of the most dangerous places to hide in this kind of transition is exactly where conventional advice tells nervous people to go. Long-term government paper, cash in a weakening currency, nominally safe structures that do not keep up with the new regime. This is the kind of environment where the appearance of safety can become a trap. Now, what tends to benefit hard assets, strategic resources, infrastructure, mining, energy systems, processing capacity? Companies connected to the physical rebuilding of production closer to home. That does not mean you run out and buy anything with the word mining or infrastructure in the name. That would be foolish. It means you understand where the flows are likely to go and then you become selective. The source material also makes a broader point I think is worth preserving. You do not need to guess every reason perfectly as long as you understand where the money is going. That is an important distinction. A lot of retail investors think they need a complete narrative before they can act. Wall Street does not operate that way. Capital often moves before the public has the polished story. Once the flows become visible enough, the largest and easiest gains are often already behind you. That is why frameworks matter more than headlines. The framework here is clear enough for me. If the old petrodollar support is weakening, then dollar-dependent safe assets become less safe than advertised. If supply chains are moving closer to the American sphere, the Western Hemisphere becomes more strategically important. If the next wave of defense, electrification, and technological build-out requires mineral intensity, then the places and companies supplying that intensity matter far more than most investors realize today. That is the core of the opportunity. Now let us talk in more concrete portfolio language, because theory without action is just elegant anxiety. What would I be cautious about? Heavy exposure to long-duration bonds, heavy dependence on cash in a weakening currency regime, blind faith that the old 60/40 safety mix will protect you the way it once did. That does not mean every bond is bad or every dollar-denominated asset must be sold. It means you should stop assuming that conventional safety still means what it used to mean. What would I want more of? Hard assets, commodity, linked exposure, precious metals as monetary insurance, selective mining and infrastructure exposure. Businesses positioned to benefit from regional supply chain consolidation in the Americas. Energy processing and transport where the economics make sense. And more broadly, productive assets that reprice upward when currency support structures weaken. Now, I want to say something very plainly because people get carried away in these discussions. You do not become resilient by blindly buying a theme. You become resilient by understanding the sequence, then selecting assets that can benefit from that sequence while avoiding the assets that get crushed by it. That is the difference between a framework and a story. A story makes you emotional. A framework makes you useful. This is also why I think the coming shift is likely to take years, not weeks. People always imagine wealth transfers as one dramatic explosion. Sometimes they are, far more often. They are long, grinding, and deeply unfair. Your salary buys less, your savings buy less, your pension feels fixed, while the real world moves around it. Meanwhile, asset owners ride the inflation wave and the capital reallocation wave upward. That is the real scandal. The wealth transfer is not hidden. It is simply not explained clearly. If you sit in cash, you lose. If you sit in fixed promises while the currency weakens, you lose. If you own the right hard and productive assets, you may not merely survive the transition, you may come out significantly ahead. That is why I keep coming back to one sentence. Become an asset owner, but not just any asset owner, the right kind. Now, I do not mean some vague social media version of asset ownership where people think buying whatever trendy stock is mentioned online qualifies them for protection. I mean assets with scarcity, pricing power, strategic importance, or a direct relationship to the reordering of trade and production. Gold and silver fit part of that. Certain miners fit part of that. Infrastructure and construction tied to the Americas fit part of that. Strategic materials businesses fit part of that. And more broadly, businesses that benefit from a weaker dollar and a harder real asset regime belong in the conversation. What I would avoid is denial. Denial is the most expensive position in all of this. People are already losing purchasing power and still telling themselves they are being conservative. They are holding savings while inflation eats them. They are hiding in fixed pensions while asset prices rise faster than the currency falls. They are waiting for certainty in a system that rewards early positioning far more than late clarity. That is how the wealth transfer works, not by one giant theft, by a long series of small, respectable mistakes that all point in the same direction. So if I had to reduce the whole situation to one practical truth, it would be this. Most investors are still watching the Middle East and thinking this story is about oil. I think the deeper story is about money, empire, trade routes, regional supply chains, strategic minerals, and the slow death of a structure that made the dollar uniquely privileged for 50 years. Once you see that, you start asking better questions. Not will the dollar vanish? That is too crude, you ask. What happens to bond demand if fewer countries need as many dollars? What happens to rates if that demand weakens? What assets do well when currencies lose purchasing power faster than the headlines admit? What regions become more strategically valuable if America pulls production and resources closer to home? Those are the real questions. And the answers to those questions are where the next serious money will be made. This transfer has already begun. It will not look obvious to most people until much later. That is how all the big transfers work. First, the structure changes, then the capital moves. Then the public notices. By the time the public notices, the winners have already been accumulating position for quite a while. That is why I think preparation matters so much here. Not panic, not politics positioning. The old world does not disappear in one day. It becomes less supportive while the new one becomes more profitable. And if you understand that early enough, you can place yourself on the side that benefits instead of the side that gets slowly diluted, without ever quite understanding why.